Hello friends, welcome to part 2 of this series which talks about how to earn 30% CAGR by spending least amount of time in stock markets. This is developed especially for job holders who can't spend much time in stock markets. If you haven't watched part 1, I highly suggest you to go there and come back here because in part 1 we have discussed some important concepts like importance of compounding and what actually is this PSS strategy, what are various hedging methods that we are going to use and advantages of this strategy. So if you haven't watched, please watch it and come back here. And in this video, we are going to exclusively discuss about equities trading. But even before that, let's have a little bit of recap on some of the concepts that we saw in the first part and then talk more about equities trading. So we know that the name of the strategy that we trade is called PSS, wherein P stands for portfolio allocation, S stands for segment allocation, and another S stands for stock allocation or strike price allocation. So if we assume that we have 100% capital, we discussed that we need to allocate 25% of our capital in any risk-free investment or financial instrument. It could even be fixed deposits. So this is 25% of our capital, and then rest 75% we use for our stock market terminals. So this is precisely what portfolio allocation is. And remember, we also talked that in this 25% investment, we may get very less returns like probably 4 to 5%, but that's fine because the goal here is not to earn returns. But in case of emergency, we need some money to fall back on. So that's the purpose of keeping this 25% aside. So we also discussed that gold and mutual funds are not perfect investments in these cases because those are not zero risk investments. And then we also discussed that the other 75% which we invest in stock markets, we will equally divide that into two parts. One is for equities and the other is for options. So this concept falls under segment allocation S. And remember, we also talked a lot more concepts in part one, as in why we invest in equities and options, how they hedge each other, and some of the calculations as well in terms of how much profits we earn, etc. And then the last is stock allocation or strike price allocation. In this, we discussed how much of capital do we need to allocate to each stocks and how many stocks do we need to trade, etc. At the same time, we also discussed about which strike price do we need to take in order to have a mathematically proven profits. So as I said, in this video, we are going to exclusively discuss about equities part of trading. One very important and underlying concept for equities trading that we have seen in previous part is diversification benefit. This is a very powerful concept where we have drawn a couple of life-changing observations. First is diversification. We saw that if we keep diversifying our capital into reasonable number of stocks, the probability of wins actually increases a lot. So to put it in a simple way, if you have 5 wins before diversification, then you might have 7 to 8 wins after applying this concept. Now, the second point here is portfolio rebalancing. In this, we learned that if we keep churning our portfolio every month, then the percentage of profits increases a lot. So in this case, percentage of profits comes into picture, right? So while the first one talks about the probability, the second one talks about percentage. That's because in the second case, we actually leave all the low performing stocks behind every month and ride on high performing stocks. So because of these two concepts, we would be able to earn more than 30% profits every year. So we have seen all this. Now in this video, we are going to focus on more things like what number is a good number of stocks to invest in, or how frequently do we need to rebalance our portfolio? Is it weekly, monthly, or yearly? So before talking about all these points, let's look at the agenda for this video and then jump into the topics. As always, this is my blog 30cagr.com, and I put all my research related videos in this. If you are interested, please go ahead and check it out. And one other thing about my blog is that as when I take any positions in equity or options, I post them immediately on my blog. So unlike other websites which post past performances or backtesting results, you get to see the live performance of stocks that I invested in. So please feel free to check my blog. All right. So here's the agenda for this video. First, we talk about top factors to consider while trading in equities, followed by the most important one, process of reallocation. So in this, we actually discuss about the frequency of rebalancing, number of stocks we invest in, etc. And then position sizing, which is very important when it comes to risk management, followed by free screeners. So in part one, I told you that there is something called screeners, which is available in many free websites. And I got many questions on how to use those screeners or how to apply the formula. So I'm going to show you how to use that. And also in the last video, I showed you one formula that I use for my trading purpose, right? In this video, I'm going to show you another formula and apply that in the screeners and show you a simple way to identify stocks that we have to invest in. And then we will also be talking about futures trading. I know that I haven't touched this part in my first video, but in this we will discuss a few things like, is it profitable to trade in futures? Can we use this diversification concept in futures trading? If so, what are some of the pros and cons of it, etc. And lastly, I'll also let you know some of the advantages of this equities trading. So first, let's discuss about top factors to consider while trading in equities. First and the most important is fundamental parameters. Before entering into any stock, we have to ensure that the quality of that stock is topmost. So fundamental parameters give us information about the quality of stock. There are many parameters like earnings per share, quarterly profits, yearly profits, etc. But again, you don't need to know all these fundamental parameters on your own. I'm going to show you how you can identify stocks which are very good at quality even without knowing these fundamental parameters. And then the next important factor is stock valuation. If stock is already valued at a higher price, the chances of moving that stock is pretty low. At the same time, if the valuation is at bottom, it's very likely that the stock moves to the top. By that, I don't mean that we need to enter at the bottom and exit at the top. No, that is not possible unless you are a professional. All we do in this equities trading is we enter into a stock, ride on it for some time, and then jump onto another stock. So it's okay even if stock has mediocre kind of level or at low levels, but just that the stock should not have a very high valuation. So this is another very important factor that we need to consider. And then the last is technical parameters. While fundamental parameters and stock valuations help us in deciding how good a company is in terms of quality and whether we can enter into a stock or not based on its valuation, technical analysis support us by giving extra strength to our decision. There are many technical indicators showing us whether a stock is in bull phase, bear phase, or in the neutral phase. So it's a good idea to take help from technical parameters as well. But in some of my formulas, I don't use technical parameters, but still successfully earn decent returns. That's because I give maximum weightage to fundamental parameters and stock valuation. So these are the three factors that we have to consider while entering into any equity stock. And then let's discuss about the process of reallocation or rebalancing. So let's discuss about a few points which we skipped in part one. First is frequency of reallocation. After doing a lot of analysis for years, we came to a conclusion that the best time to reallocate your portfolio is monthly. We have tested this on daily, weekly, monthly, half yearly, and yearly, but monthly proved to be the best in terms of profits. And remember, it is not just about the profits but also the drawdown. The drawdown seems to be decent if you keep churning your portfolio every month. Whereas if you pick any other time frame like weekly or half yearly, drawdowns are a bit high. So the best time to churn your portfolio is monthly. And then the next is, how many stocks do we need to hold? Is it 5, 10, 15, 20? So there are pros and cons of holding high number of stocks or low number of stocks. But the optimum number of stocks to have maximum profit is 10. While some people ask me, can't I hold more than 10 or 15 so that I can further diversify our portfolio? Yes, you can do that, but in terms of management, it becomes a little difficult to manage more than 10 stocks. At the same time, if you trade in less than 10 stocks, your portfolio would be more vulnerable to markets. Just because you are investing in less number of stocks, if there is any bad news, your drawdown would be more. So what we ideally suggest is invest in 10 stocks and have a monthly rebalance of portfolio. So the number of stocks that we would trade in are 10. And then the most important, process. How do we rebalance our portfolio, or how do we manage our profits or losses that we earned in last month? So this is where most of the traders go wrong. Remember, we talked about compounding in part 1. So we have to keep invest our profits in stock markets again. At the same time, if we get loss, we need to know how to reallocate based on previous month's losses. So let's take an example. We have 5 lakhs in our portfolio and we decided to allocate 1 lakh to each stock. So ideally we would be investing in 5 stocks with a 5 lakhs capital. Now imagine that you got 20% profit in each stock. Just because we invested 1 lakh in each stock, profit that we would get is 20,000 per stock. And since we invested in 5 stocks, 1 lakh would be our monthly profit. And if you add the original capital to your profit, you would have 6 lakhs at the end of first month. Now, when you are investing in the second month, make sure you divide this again into 5 stocks, which means this time each stock would have 1.2 lakh instead of 1 lakh. This way, we are reinvesting all the amount that we earned, and this is how compounding effect takes place over long term. At the same time, let's say we got a loss of 20%. So in each stock, we would get a loss of 20,000. And since we invested in 5 stocks, we would get a loss of 1 lakh by end of first month. So subtracting 1 lakh from our 5 lakh capital, you would be left with 4 lakhs at the end of first month. Even in this case, we have to divide this by 5 and invest 80,000 in the second month. This entire concept of rebalancing acts like an index. We know how index goes up and down as per changes in stock prices, right? Same way our portfolio would also go up and down as per the profits that we get in our stocks. But over a period of time, maybe after 10 years or 15 years, because we are trading in high quality stocks, there is a very high chance that we would get more than 30% profits every year. Again, one point to remember here is this entire process is for long term. So you might experience losses in the first few months, but keep doing this for the next 5 or 10 years and you would definitely see profits in your portfolio. As I said in part 1, generally in every market cycle of 10 years, 5 to 6 years, markets appreciate your capital in a very big way, and then other 3 to 4 years markets might consolidate or be in the bearish phase. If markets are in bearish phase, whatever stocks you take, you end up in loss only. And exactly for that reason, we are investing our other 50% in call options writing. So these 3 to 4 years when markets are continuously in bear phase, we keep getting continuous profits on the option side because there we are selling call options. So the losses that you get in equities will get offset by the profits that you get in options trading. We will discuss more about options trading in the next video. But for now, just remember that whatever profits or loss that you get in previous month have to be accounted for. So these are the 3 most important takeaways from this video. First is the frequency that should be churned monthly, and then the number of stocks that we would like to invest are 10. And then the last is whatever profits or losses that you get, you have to account that and accordingly reinvest your amount in stocks. And then the next is position sizing. I would like to shuffle the order a little bit here. Before talking about position sizing, I want to discuss about futures trading. We haven't discussed anything about futures trading in part 1. That's because there are a few reasons why we are not able to trade in futures. In fact, this is a limitation from my side. But if you are better than me and you come up with any strategy or algorithm that continuously gives more than 30% returns in futures, I would strongly encourage you to go ahead with that because there are many advantages of trading in futures compared to equities. First and the foremost is slippages. You have very less slippages in futures compared to equities trading, right? Because in equities you have to take shares individually, but when it comes to futures they are available in lots, so the slippage is much lesser compared to equities. That's the first important point. And then the second is volumes. Of course these two go hand in hand. Because you have more volumes in future stocks, it is easy for us to enter or exit whenever we want. Whereas when it comes to equities, it would be a little difficult if a particular stock does not have good volumes. This becomes a problem, especially when you are trying to exit a stock. So these two are the major reasons why even I would like to trade in futures. But as I said, I couldn't come up with a strategy or algorithm which gives 30% returns continuously year over year in futures trading. So if you find any, please let us know so that I can share with others as well. Now we talked about advantages of trading in futures, right? But I would also like to explain the limitations of trading in futures. The first and foremost is futures trading is available only in around 200 stocks, right? So that limits the scope of basket of stocks that we can trade in. Whereas when it comes to equities, generally we focus on Nifty 500. So we do have a huge spectrum of stocks available in equities. And the next point is if you look at the historical results, we get more profits in mid cap and small cap stocks. And so the potential to rise in this sector is more. Whereas in these 200 stocks that are in futures, we don't have many mid cap or small cap stocks. Again, these two might go hand in hand, but these are some of the reasons why we are not able to make as much profits as we make in equities, especially Nifty 500 stocks. All right. Now that we discussed about futures trading, let's jump into position sizing. The reason why I wanted to first discuss about futures trading is I want to plug in futures trading with position sizing. In case you are developing a strategy for futures trading, you have to keep an important point in mind. We already get an inbuilt leverage for futures trading, right? Let's say there is a stock that is trading at 1000 rupees and to buy 1000 quantity, you need 10 lakhs. But if you go to futures, you might get it for 1 lakh or 2 lakhs. So for demonstration purpose, let's say you just need 1 lakh to purchase 1000 quantity of this stock. So that's precisely what happens in futures, right? But remember that if you plan to include futures trading in PSS strategy, keep the entire amount aside without using any leverage. Yes, you get it for 1 lakh, but make sure that you put 9 lakhs aside. That's because we have to treat this entire concept same as we trade in equities. If you start taking exposure, you get more profits and more losses. And let's say you have consecutive losses for 1 year, and then that would blow up your portfolio. That's because you are taking a very high leverage of 10 times or 5 times. So talking about position sizing, make sure that you have full amount even if you want to take one lot in futures. And so small investors can't really enter into this futures trading. That in fact is another reason why we wouldn't want to trade in futures. And now let's talk about position sizing in equities. It is very important to understand that we would blow up our portfolio if we invest our amount in less number of stocks. So if you recollect, what we are doing in this strategy is firstly we are putting 25% aside for zero risk investment, right? Which means we are eliminating 25% of risk here. And then even in other 75%, we are dividing it into two and only investing 37.5% in equities. And again, if you remember, I told you that it's better to invest this in 10 stocks. So ideally, we are investing 3.75% in each stock. Imagine a case where there is a bad news in stock and the stock went to zero. Even in that case, you would only lose just 3.75% of your entire portfolio. That's the power of position sizing. Remember, risk management is everything in stock markets, and the cornerstone of risk management is position sizing. So, it is very important to make sure that we do not over invest in any single instrument. And this is precisely why I asked not to take leverage if you are trading in futures. All right. Now that we know about process of diversifying our portfolio and position sizing, let's move to the interesting part, how to make use of screeners and what are some of the formulas that I use for my trading. So this is the formula that you have seen in video 1 also. One of the formulas that I use for my trading, wherein we have trailing 12 months EPS and then comparing current EPS with 1 year ago EPS, and then we also have included a technical parameter, relative strength index. This formula generally gives 40% CAGR over long term, and the drawdown is 30%. Remember, again in previous video we saw how a 30% drawdown ends up being just 5% or 10% because of various diversifications that we are doing in our portfolio, right? So even if you see 30% here, you would end up having just 10% drawdown. And as we discussed, frequency of churn in this case is monthly. Of course, I do have some formulas which gives better profits if we churn quarterly, but this formula works best with monthly reallocation. After I showed this formula in the first video, I got many questions from people saying that it's difficult to implement this in screeners because they don't have any knowledge on fundamental parameters. First thing is, you don't need to have any knowledge. You just have to go to some websites which offer free screeners, which I'm going to show you in a bit, and simply enter these four conditions and you would get list of stocks that you have to trade in. But considering their request, I decided to show you another formula which is very easy to implement in screener and get to know stocks that we need to trade in. Alright, this is the formula. There is just one condition, and that says if Petrosky score is greater than 7, then you can straight away go and enter into that stock. Before seeing what is Petrosky score and how to apply this in the screeners, let's look at the profits that we would get and then the drawdown. In this formula, we get 35% returns, and then the drawdown is way lesser than what we have seen earlier. In this case, you just have 19% drawdown. So again, considering all the diversifications that we have done, this might end up being just 5% drawdown. And again, the frequency of churn in this case is also monthly. So if you ask me which formula would I consider, because previous formula delivers 40% CAGR compared to 35% in this case. But when it comes to drawdown, previous formula has 30% drawdown and this has just 19%. I would personally choose this formula because more than CAGR, drawdowns are very important when it comes to portfolio management. And also it is very easy to execute just because it has just one condition. All right, now let's go ahead and see what is Petrosky score and what are some of the websites that offer free screeners. So you can go to Google and type Petrosky score or directly come to Investopedia to find its definition. Petrosky score is a way to pick stocks based on 9 different parameters. So instead of we doing heavy lifting of identifying what are the best fundamental parameters that we have to consider, Petrosky score does that for us. So if you see, it takes into consideration all these factors, and for each criteria it gives 1 point. So if a stock has higher Petrosky score, it means that the stock is good in terms of quality. And at the same time, if the score is pretty low, then we wouldn't consider that stock to trade or invest in. So as I said, you don't need to do any kind of heavy lifting. It's absolutely okay if you do not know anything about fundamental parameters like how to read balance sheet, what's earning per ratio, what is price earnings, etc. All you have to do is go to screeners and enter a condition where Petrosky score is more than 7, which means we are basically identifying stocks which have 8 and 9 score, which also means those are the top most stocks in terms of quality. Now let's see some of the websites that offer these screeners for free. All right, I tried to gather some websites which offer these screeners for free, but there are many others as well. So just for this example, let me take the first website. So now I am in screener.in. All I have to do is just hit on screens and hit on new stock screen. You get this space to enter your query. All I do here is just enter PI and it gives me an option in the drop down. I pick Petrosky score and you have to enter greater than 7. So hit on this show all ratios that gives you various other options. Select greater than and just enter 7. And then you also get an option whether to show companies where recent quarter results are available or not. But this really depends on website to website. I leave that as is and run the query. All right. Now you have 254 stocks whose Petrosky score is greater than 7. Now the next step is how to identify what stocks do we need to take out of these 254. So what I would suggest is sort this Petrosky score column so that you see stocks with highest score at the top. That's the first step you have to perform. And then the second is pick whichever stocks fall under Nifty 500 group. That's because if you look at the market cap, you see stocks which have very less numbers. So these are not even mid cap or small cap. These are micro cap stocks which are not very good to trade because as I said, we need volumes to trade and we generally have volumes only in large cap, mid cap or small cap stocks. Just to avoid that, all you have to do is pick these stocks and validate against Nifty 500 group. If a stock is present in Nifty 500 group, just go ahead and enter into the stock. Very simple, right? All you have to do is come once every month, that is generally on first of every month, put a small condition, Petrosky score greater than 7, sort the stocks by the score, and then pick the stocks which are in Nifty 500 group. This entire process would take not more than 1 hour, but the amount of returns that you get over a period of time would be massive. But let me also tell you what I do in my case. I do have 6 to 8 other formulas which I run over screeners every month. And after I get a bunch of stocks, I apply another layer to identify best of best stocks in that group. So if you don't have even to spend 1 hour, all I would suggest you is visit my blog 30cagr.com on first of every month before market opens and follow what I'm trading in. But in case if you do have some time, you can go through this small process and identify stocks yourself. That brings us to the last part of this video. What are some of the advantages of this diversification benefit? First and the most important is time investment. If you are a job holder, you don't need to spend much time. All you have to do is spend around 1 hour, do the process that I just explained. And as I said, if you do not have even that 1 hour, all you have to do is visit my blog on first of every month and get best of best stocks for that 1 month. And then as we have already seen, we get more than 30% returns on an average every year. Please remember that this 30% CAGR is an average. Some years you might get even 50-60% when markets appreciate in a big way, and some years you might even get negative returns. But if you keep doing this for 5, 10, 15 years, average returns that you would earn would be 30%. And since we are trading in long term, we don't need to undergo any stress. And another important piece of this strategy is less drawdown. We've already seen even during market downturns how our portfolio will just have a drawdown of around just 10%. And then last but not the least, we are already entering into high quality stocks, so the risk of blowing up our portfolio is very minimum. So you can safely trade in this strategy without any stress or fear. All right, we have finished second video in this series, and please make sure that you go through the other 3 videos as well, which focuses on options trading, risk management and money management respectively. And I would wrap up the series by showing you some of the tools that I use and also help you in case if you want to trade just like me. So please watch all 5 videos of this series to have a full understanding of the strategy. And as always, all these videos are for free of cost as I'm a big advocate of free education. So you don't need to pay even a penny. But what I would request you is in case if you find any content valuable in this video, please consider sharing it with your friends or in any other trading community. Also note that I make 1 to 2 no nonsense videos every week. So please click on subscribe and hit on bell icon so that you won't miss any video that comes out of my blog. Thank you and see you in the next video.